I want to start with your contrarian thinking and independent mindset because, I heard in a recent interview that you've sold off all your US and India holdings and moved it to fixed income.
No, not all.
Okay.
US, I sold most. India, I did not sell all. I sold, I think, maybe 50-60%.
Okay.
So I still have a lot of India exposure. It's not to say I don't, but US, I was pretty much out of it.
Okay, so let's talk about some of the thinking that went behind it. What were some of the data factors that led you to make this decision?
So primarily, I am a cycle investor.
Yeah.
That's the way I've always, not always, but from the time I could understand how markets work. And markets have an inner mechanism and they are not random, much as professors in finance would have led us to believe. The markets are not random. Uh, there is an inner method. And when you do this for a period of time, then you start to realize that there is an intrinsic method to the market cycles. I'm talking the macro of the market. Small companies have a different trajectory, but broad macro of a market have a cycle. And right from, let's say, the dot-com era up until now, I've followed that and it's worked out really, really well for me. In the sense that I made this theory, which I called it the lake of returns, but I did not call it in the beginning, but I basically intrinsically understood in the dot-com boom, which started in 97 or so, 98, um, peaked in 2 years' time. And then, of course, there was mayhem later. Why did it peak? There are many reasons uh, from a fundamental standpoint, to attribute a peaking, which is that uh, bubble and valuations and this and that. But I said that you could have said that at any point in time. I mean, the bubble started in 98.
Yeah.
You know, everything was trading at 30, 40 earnings, and we thought they were very, very expensive, like the Indian IT services companies. And I thought I also made the mistake of thinking they were very expensive. Then they went to 60 times earnings, then they went to 80 times, they went to 100 times, they went to 200 times, they went to 400 times, they went to 600 times. At which point do you say it's overvalued? Because then you have missed out a giant bull run.
Yeah.
So then I said there has to be something more to it than that, more than just the fundamentals and the technicals. And that's when I then looked at market history, and it kind of, the beginnings of that thinking started to come, that markets have finite returns on aggregate. Stocks can have reasonably, not infinite, but much higher than market returns. But markets intrinsically have finite returns. It's a lake, not a endless flow of returns. It has limited capacity for returns. And once you breach the danger mark of that lake, whatever the lake you're talking about, whether it's equity lake or tech lake or real estate lake, commodity lake, you are then reaching a point at which that will burst. And that burst, actually, I was just forming that thinking in 99, and by 2000 February, I was looking at the data, and the Nasdaq, I think, had doubled in 1 year. And then when I looked at the Nasdaq's history and I normalized the returns, I said, this is simply nuts. No matter how great the era of those tech companies was, which is maybe eBay and Intels of the world, AMDs, Qualcomms, there has to be a finite amount of returns any company and an aggregate bunch of companies can deliver. And I said, boss, this is, I think, way beyond it can sustain. I made that broad thinking. I exited. Now, you can call it luck, you can call it skill, or usually it's a combination of the two things. And the markets then obviously totally tanked from 2000, remained like that for several years. Again, the bull market started in 2003-4. And it was the exact opposite, that the crash in the tech and overall indexes was so much that the returns had become dry. That lake was ripe for filling up. And I got that cycle right. And exactly the opposite of that in 2007 December, when I was sitting in my personal room where a bunch of guys with me used to sit, and I said, "Was this market is headed for disaster?" And there was no sign that there was disaster on the horizon. It was simply that India had returned 55% CAGR for those 4 years, 2003 to 7. Your normalized returns of 15%. You're running at 3x. This lake's capacity is 15. You're running at 45, 50, 55. Now, you don't sell at that point. You wait for confirmation of whatever your hypothesis is. And the confirmation came from subprime. So some event will happen
Yeah.
to make that balloon get pricked. So that's the way I invest. Company micros are all great, and I have a bunch of companies in India. But the macro in 2004 on the lake of returns, in 2024, in the lake of returns told me normalized returns in India have come down because of lower nominal GDP growth. Now it's more in the 10-11%, mirroring the nominal GDP growth. And we had return on the Nifty 27% from
Yeah.
the start of this bull market. We started in COVID. And small caps have returned 18-19% over a 25-year period. They had returned 48%.
Yeah.
You're 2x. I said, boss, this lake is again way beyond the high water mark. Time to lighten up as much as you can. Identical pattern was there in the US market. Now, so I exited what I could in India. Many things. I mean, obviously, US is a very liquid market. You can exit everything. India is not that liquid, especially in the smaller mid cap areas. So you have to be more patient. But now you look back in the last, let's say, 10 months from that peak, those peaks.
Yeah.
India is from September levels are high. We are still down about 5%.
Yeah.
From 0.2 weeks, we are up about 4%. In this, and the US is about flat in the same period. In the same period, other markets have been on a blowout trajectory. I mean, Germany, Italy, Spain, Colombia, Chile, uh, Mexico, Brazil, even China. So, I mean, I'm a global investor. For me, India is my home turf, but not my only turf where I play. My capital is mobile. My capital is uncaged. Now, I've made a ton of money just for that decision that lighten up India, get out of US. You're not getting into cash. You got into fixed income because the world economy doesn't look that hot right now because of tariff wars,
Yeah.
blah, blah, blah. Good to sometimes play defense. But the offense part has happened in markets which traditionally made me a lot of money, which is India and the US. So that's my broad framework of investing. Within this, stocks are a different game altogether, where I'm happy to hold a number of companies for several years. But macro of the market follows cycles, and I like to follow that. Also, one thing, I can tell you that no matter how much of stock picking you do, and we will always have exceptions to the rule. So let's not go into the exceptions. Every data set will have the outliers. Ignore that. Most of your returns will happen because of getting the big top-down calls right. 60-70% of returns flow from getting the macro right. Which asset class? Start from right at the apex of the mountain. Is it equities? Is it fixed income? Is it REITs? Is it commodities? From there, your returns will start to diminish. If you get the equity call right, it doesn't much matter which equity markets you are long. And as long as you're a diversified basket of 5, 10 markets, you're fine. Let's say you got emerging markets within equities. It doesn't matter which emerging market you bought. Most of them will follow the trend of the EM index itself. If you got developed right, there are 10, 20 markets in developed. So that's the point that I have been attuned and used to getting the macro picture clearer before I get the micro. Now, once I catch a small cap bull market in India, as I did during COVID, at the beginning of COVID, I said, this is the era of small caps.
Yeah, you were on TV asking everyone to buy.
Buy small cap, buy small cap, buy small cap. Now, did it matter you bought X or Y or Z? It didn't matter. The index gave you 48%. Individuals might have compounded 75%, 100%. But just buying the index gave you 48%. If you got that one macro call right, you can sit back and go to the beach.
Absolutely.
That's the way I look at investing. It has to be a high return on time. That's because look, I want to enjoy the money I make. I don't want to be in front of a screen all day, all night. That's not my mantra, not my calling.
Yeah.
When you look at macros, get the macro clear, you free up a lot of time.